China has effectively shut the door on Canadian canola. A provisional 75.8% tariff on Canadian canola seed announced this week has sent shockwaves through the prairies and beyond, hitting farmers, exporters, and processing plants at one of the worst possible moments during harvest planning and contract season. For growers who already invested in seed, fertilizer, and labor, this isn't a future problem, it's a crisis happening now. For years, China was one of Canada's largest canola buyers, with exports worth nearly $3.6 billion in 2024. That market has now all but vanished overnight. Beijing's new duty follows earlier moves this year that slapped 100% tariffs on canola meal and oil, and officials say these measures respond to alleged unfair subsidies and, more broadly, to Canada's tariffs on Chinese electric vehicles. Whatever the stated justification, the practical effect is immediate and brutal. Shipments to China have dried up, futures have tumbled, and sellers are scrambling to find buyers elsewhere. Traders reacted quickly. Canola futures dropped roughly 6.5% on the Intercontinental Exchange, and analysts warned prices could slide further. Some exporters are diverting shipments to the United States, but that's not a neat solution. American buyers will only take extra supply at steep discounts. Reports indicate sellers are being forced to chop prices by as much as 30% to move cargo. Those markdowns translate into millions of dollars lost across the supply chain, hitting first the trading companies and processors, then the farmers and co-ops who actually grow and supply the product. The fallout goes far beyond balance sheets. Canola is one of Canada's most valuable crops, underpinning livelihoods across Saskatchewan, Alberta, and Manitoba. Many growers had already planted this year expecting contracts and steady shipments to China. Now they face unsold grain, rising storage costs, and intense uncertainty about revenues, all of which threaten hiring, equipment purchases, and next season's planning. Small operations, with narrower margins and less storage capacity, are particularly exposed. Processing plants and logistics networks must adjust on the fly. Some importers are attempting to redirect product into Southeast Asia or South Korea, or to buyers who will blend canola into animal feed. But finding suitable alternative markets at acceptable prices is neither quick nor guaranteed. Storage is filling up, handling charges are rising, and the scramble to reroute shipments is creating bottlenecks across the country. Politically, the tariffs underscore how vulnerable Canada can be when a large share of one commodity is tied to a single foreign market. Ottawa has pushed diplomatic and trade efforts to smooth relations with Beijing, efforts led by senior negotiators since June. But the new duties show those efforts have not prevented China from taking aggressive trade action. Provincial leaders have reacted sharply. Saskatchewan's premier has called for immediate intervention and even plans to travel to China to press for relief, while other officials urge Ottawa to match the attention given to other hard-hit sectors. Federal ministers responded publicly with disappointment, arguing Canadian farmers do not engage in dumping and pledging to defend fair trade. Behind the scenes, officials are said to be exploring emergency supports, such as temporary storage assistance and programs to diversify markets. But farmers want a clear, immediate plan, not vague promises. Words alone won't replace billions in lost sales or remove the supply chain disruption already underway. This latest escalation is widely seen as retaliatory, part of a tit-for-tat pattern that began months ago with tariffs on electric vehicles and expanded into duties on agricultural goods. Experts warn that repeated reliance on a single export destination leaves producers exposed to sudden diplomatic or trade shifts. The solution will require a mix of short-term relief to prevent financial collapse and a long-term strategy to diversify markets and strengthen domestic resilience. For communities built around agriculture, this is intensely personal. Beyond commodity prices, the tariffs threaten livelihoods, employment, and the local economies that depend on planting, harvesting, and processing seasons. The human cost shows up in sleepless nights for farmers, hurried conversations with lenders, and families wondering if they can keep operations going while waiting for policy responses. Exporters and processors are doing what they can, offering steep discounts to move grain, testing new markets, and trying to coordinate logistics to avoid gridlock. But these are stopgap fixes, and many observers worry about the longer-term consequences if Canada does not reduce its exposure to abrupt market closures. The immediate priorities are clear: stabilize prices where possible, provide short-term supports for storage and cash flow, and accelerate efforts to open alternative markets. Policymakers will also need to reassess trade strategies and explore how to shield Canadian agriculture from future shocks, whether through insurance mechanisms, strategic stockpiles, or faster market diversification initiatives. For now, farmers in the prairies face a season they didn't expect, one where decades of trade relationships can be altered almost overnight. The coming weeks will be decisive. The response from Ottawa, reactions from trading partners, and how quickly alternative buyers can absorb surplus will determine whether this shock becomes a temporary disruption or a long-term blow to an industry that feeds millions and supports thousands of Canadian families.